Hey, good morning. This is Mayor Valensky with Driving Market. So let's open up with a caveat to be absolutely clear. This broadcast is opinion only. It's not advice. It's not investment advice. I'm not licensed. I don't have any license to give you advice. Okay, it's your money, stays in your account. You choose the platform where you want to trade with. This is only a general broadcast opinion on financial markets. That does not mean I have expertise. It does not mean that I am a professional. It doesn't mean that you can go by my advice. It doesn't mean anything. It's just a general picture of a personal opinion that I put on YouTube. That's simply it. Okay, so take that as a caveat. And also, it's your money, stays in your account. You choose the platform. Nothing to do with me. You want to use this information, great. If you make money, great. If you lose money, sorry, that's the way it goes. There's no intention for you to lose money, but that is an important caveat that we have at the beginning of the YouTube, because there is definitely maybe an opinion out there that I'm giving advice, and I'm not giving any advice. So let's get rolling. Okay, so the main thing driving the markets at the moment is fear of recession and fear of inflation. We've got inflation numbers out in the States this week, which is a consumer price index and producer price index. So keep an eye on those. What's likely to happen is that there's a feed into safety. So you had bond prices jump up yesterday as investors moved money out of higher risk assets or riskier assets and moved over to the safety of bonds, because they're expecting inflation to be at a more than 40-year high when it comes out this week. So that's something very much to keep an eye on. Inflation is the big driver. Remember, inflation started off with a supply-driven issue more than a price-driven issue. So it was the lack of supply that drove up the demand, and therefore the demand drove up the prices. Okay, so you can't get the goods in the shop, and therefore the prices rise. What's interesting yesterday, as Elon Musk said last week, in my opinion, Elon Musk would probably pull out of the deal, and yesterday he pulled out of the Twitter deal. So Twitter fell 10% and Tesla fell 6.5%. I think it's a good thing, because Twitter is very, very, very opaque. It's very unclear what's going on there, and Elon wanted to know the facts, and I think the amount of users is not correct. So it's not true, the amount of users that they've got at Twitter, and so Elon Musk has pulled out of the 44 billion deal for the moment. He'll probably go back in when Twitter is running at around about the $20 level, which I think it will float down there by the end of the year or early next year. Twitter's got no direction, it's got no plan, it can't really monetize its platform, and it's got huge competition now because of the drop in advertising revenue. You've got the competitors of Meta and Google, and everyone's looking for the same client and the same money in order to pay for their advertising costs, etc., and their advertising revenue. So Twitter is on the down. As regards cryptos also yesterday had a slight down day. I was hoping that Bitcoin would hold at the 20,000 level, but it's hovering around about there now. It could be forming a base, but if inflation continues rising and fears of recession come in, then you see cryptos fall even further. Yesterday they were all in the red. The Litecoins, the Bitcoins, polka dots, they were all in the red yesterday. So and in the red this morning when the market's opening up. So you're probably going to have a slight downtrend until we're sure as which direction inflation is going. You've also got the casinos and also the gaming companies in Macau were down, simply because there's a COVID-19. There could be more closures in China, and that's going to frustrate further the supply chain, which could further frustrate inflation. So again, I've been very specific here. I think inflation is going to be running at 12-13%. I think interest rates are going to be running at 8-9%, 7-8-9%. I think they're far too low, but there is a problem there, because if they raise interest rates too high, they could kill off the economy, as Esther George said, of the one of the Fed members, stated that she says interest rates could be too aggressive. She was one of the members of the Fed that did not want a 75 basis point rise. She wanted a 50 basis point rise. So she is pushing for a lower interest rate rise in order to help the economy sustain its growth. But we do have full employment, and full employment is a good factor, and it's unlikely to be a recession if there is full employment. So that's something to keep an eye on. The technology stocks were down yesterday. Where to look for the action is, you've definitely got action in FX, and the euro is going to 1-on-1. It's only 60 points away from it, and I think it's going to fall below 1-on-1. I think the euro is in a very, very downward trend, and it could be hammered up until the end of the year. year, and the dollar is particularly strong and is only going to get stronger in the near term, in my opinion. So that's more or less it for today. Again, if you want to catch me, you can catch me on any of the media, but be very clear that this is only a macro picture. It's not advice, it's not investment advice, not financial advice, and you should choose your own platform and trade on your own platform with your own money that you have access to. Okay, Mayor Walensky, Driving Markets. Have a good day.